We all buy insurance for pretty much one big reason: peace of mind. It's supposed to be this financial safety net, right? The thing that catches us when life throws a massive curveball. But what happens when that safety net is, well, designed to have holes in it? Okay, let's get into it. We're going to explore a strategy that some say totally transformed the insurance industry and changed a game you probably didn't even know you were playing. Just picture it for a second. A pipe bursts and your house floods. Or maybe you're in a bad car wreck and you're left with serious injuries. You file a claim, expecting the help you've been paying for, but instead, you just get a fight. And look, this isn't some made-up story. According to our sources, this is the reality thousands of people face when that promise of security just gets shattered. All right, so first, let's just quickly talk about how insurance is supposed to work. Because at its heart, it's actually a pretty incredible concept. It's this idea that lets us build our lives and take risks, knowing we have a backstop for the really bad stuff. The whole idea is called risk transfer. It's simple, really. You pay your premium, that's your small, predictable payment, and in return, the insurance company takes on the risk of a gigantic, unpredictable loss, like, your house burning down. It's basically a system where we all chip in a little bit to protect the few who get hit with a catastrophe.
And this promise of security, it isn't just buried in the fine print of a policy. It is baked right into our culture. For decades, these companies have spent billions of dollars on ads to convince us they're our good neighbor, that we're in good hands. That trust is literally the foundation the whole industry is supposed to be built on.
So what happens when that promise of being a good neighbor smacks right into the reality of corporate profit goals? Well, that brings us to the core of this whole thing. A three-word strategy that completely reshaped how claims are handled: delay, deny, and defend.
First up, delay. The tactic here is pretty straightforward. Just drag everything out. By stalling, a company can really wear down a claimant who's probably already in a tough spot financially after a disaster. And here's the kicker. Every single day a claim goes unpaid, the company is earning investment income on that money. It's what Warren Buffett famously calls the float.
Next up, deny. This is basically the art of saying no. It can be anything from making a ridiculously low offer, that's called lowballing, to just flat out rejecting a claim that's perfectly valid. The whole point is to systematically pay out less than what you actually owe, pushing the policyholder to either just give up or take pennies on the dollar.
And finally, defend. This is the muscle. If you refuse to accept the delay or the denial and you decide to sue, well, the company digs in for a massive fight. They unleash their huge legal teams to basically wage a war of attrition, making the whole process so expensive and so draining that a lot of people are just forced to give up.
So you have to ask, how did we even get here? This whole strategic shift didn't just appear out of nowhere. It was really born out of a perfect financial storm that absolutely hammered the insurance industry back in the late 80s and early 90s.
So let's look at what happened. It all started with what's called a soft market, basically a huge price war that drove premiums way down. Then, bam, a series of unbelievable natural disasters hits. Hurricane Hugo, then Andrew, then the Northridge earthquake in California. We're talking catastrophic losses. And all of this is happening right as this new corporate mindset is taking over America, one that was laser-focused on maximizing shareholder value above everything else.
Just look at Hurricane Andrew. That storm alone caused $16 billion in insured losses. That's billion with a B. It was so bad, it actually bankrupted 11 insurance companies. The rest of the industry was panicking, scrambling for a way to get back to being profitable.
So facing this huge crisis, many of the biggest insurers in the country all turned to the same place for help, one of the world's most powerful consulting firms, McKinsey Company, and their assignment? To completely re-engineer the claims department from the ground up.
And the change was dramatic. See, the old way of thinking was that the claims department was there to fulfill the company's promise. You just pay what you owe. But the new McKinsey model, it reframed the entire thing. The goal wasn't just to pay claims anymore, it was to manage them for maximum profit. All of a sudden, the claims department wasn't a cost center. No, it was a profit center.
And the key to this whole new way of thinking? It all came down to one little piece of corporate jargon: leakage. McKinsey started calling any money paid on a claim that they thought could have been avoided leakage. And with that one word, everything changed. Paying what you owed a customer wasn't keeping a promise anymore. It was a leak in the company's profits. The new mission was to plug that leak.
So how'd they do it?
Well, the playbook was pretty specific. They started using computer systems to automatically generate lowball offers. They trained adjusters to actively discourage people from hiring lawyers. They started making settlement offers on a take-it-or-litigate basis, and if you chose to fight, defend, defend, defend. The whole process was completely re-engineered to systematically drive down payouts.
Okay, so what was the actual real-world impact of all this? Well, if you look at the numbers, the story becomes pretty darn clear.
So back in 1987, before this big shift, the industry was paying out about 67 cents in claims for every single dollar collected in premiums. Makes sense. But by 2007, after these new strategies were everywhere, that number had dropped all the way down to 56 cents. Now, an 11-cent difference might not sound like a lot, but when you spread that across billions and billions in premiums, you're talking about a massive transfer of wealth away from policyholders and back to the insurance companies.
And this quote just says it all. It's from the source material, and it's describing McKinsey's own presentation. They literally framed the new strategy as moving from good hands to boxing gloves. And for the policyholder, the choice became pretty simple. Either take the lowball offer or get ready for a long, brutal fight in court.
And that really leaves us with one final crucial question. When you are at your absolute lowest and you turn to your insurance company for the very help you've been paying for year after year, who's going to answer that call? Is it the good neighbor from the commercials, or is it the bottom line from the corporate playbook? It's definitely something to think about the next time you pay that premium.